welcome to the Money Vision IQ podcast. Today we're diving deep into something really crucial for anyone managing their personal finances. Understanding the basics of economics. You shared this pretty comprehensive document, understanding general economic principles for better personal finance, and our mission is basically to unpack the key ideas in there and see how they directly impact our money decisions day to day.
Absolutely. Yeah, the material really covers a lot, doesn't it? From like the real fundamental supply and demand all the way up to the bigger forces. Things like inflation, recession, what central banks and governments are actually doing. And we'll also touch on different economic systems and how that overall economic growth connects back to your own finances.
Right. So think of this deep dive as maybe your personal shortcut to understanding these big economic forces shaping your financial world. Hopefully helping you make, more informed choices without getting totally bogged down in jargon. Money Vision IQ podcast.
Okay, let's start building that economic toolkit. Let's begin right at the foundation, supply and demand. Okay, so at its very core, economics is grappling with supply, basically. How much of something is available, right? Goods, services, and demand. That's how much people actually want to buy it. And crucially, can afford to buy it. And what's really interesting is how these two fundamental forces are always interacting. That's what sets prices.
Yeah. And it seems like a pretty straightforward relationship most of the time. Like if the price of something shoots up, people generally want less of it. That's that law of demand, the inverse relationship.
Precisely. And then the law of supply works the other way around. Typically, as the price goes up, the suppliers, the businesses, they're willing to make more of it available. So that's a direct relationship. Price up, supply up.
Got it. And where those two lines cross on the graph, basically where the amount people want matches the amount available. That's the sweet spot, right? The equilibrium price.
Exactly. That's the market clearing price. But, it's not static. Lots of things can shift demand around. Think about price elasticity,
right? How
sensitive is demand to a price change? Like gasoline, it tends to be pretty inelastic, doesn't it? Price jumps, but you still kind of need to fill your tank.
Right. You got to get to work.
But maybe some non-essential item with loads of alternatives, demand for that is probably much more elastic. A small price change might make you switch. And of course, income levels matter hugely, whether something's a necessity or just a want, if there are substitutes available and just, how many potential buyers there are.
Makes total sense. So for things we really need, price hikes don't deter us as much. But for the fun stuff, we might pause. What about the supply side then? What pushes supply up or down?
Yeah, supply has its own set of influencers. Key things include the price of other things a producer could make instead. Like if the price of corn goes up, maybe farmers plant less soy. Technology is huge too. Better tech can make production cheaper or faster. And then there are the basic costs of production, labor, materials, energy, all that stuff.
Okay. You mentioned price elasticity for demand. Does that apply on the supply side too? How quickly can suppliers react?
It does, yes. Supply elasticity measures how responsive the quantity supplied is to price changes. But the material we looked at really emphasized the demand elasticity side. It highlighted how businesses use that understanding, how sensitive customers are when they're setting their prices.
Okay. So businesses are always playing that game, trying to price high enough for profit, but not so high that people just walk away.
That's the constant balancing act. And while supply and demand is like Econ 101, it's not a perfect law always. There are exceptions. Like Veblen goods, think luxury watches or super expensive cars. Sometimes demand actually increases when the price goes up because it signals status.
Right, the snob effect.
Exactly.
Yeah.
And then in command economies, the government basically sets prices, so market forces don't really operate in the same way.
Okay. So this isn't just theory. How does understanding supply and demand actually help me with my own budget, my everyday spending?
Well, connecting it to your finances, it's about understanding why prices change. You see a price hike for something you buy regularly. Is it because supply got disrupted? Or did everyone suddenly want it more? Knowing that helps you anticipate. And understanding elasticity for yourself is powerful. If you know your demand for, say, a specific brand of coffee is elastic, you'll happily switch if the price goes up. You have more control over your spending. But for things where your demand is inelastic, like maybe essential medication, you have less wiggle room in your budget when prices rise.
Right. Distinguishing needs from wants and knowing where I have flexibility. You also mentioned non-price factors shifting things like the supply chain mess during COVID.
Yeah, that's a perfect example of a non-price determinant. Those disruptions drastically cut the supply of loads of things. So prices went up not because we suddenly wanted more computer chips, but because fewer were available. That's a supply shift. Or Think about a sudden trend. Maybe a new diet craze makes avocados super popular. Demand shoots up, shifting the curve, and prices follow. Understanding this helps you see that price changes aren't just about, the cost of making the thing. Wider market dynamics are constantly at play. Money Vision IQ podcast.
Okay, groundwork laid. Let's move to a big one we hear constantly. Inflation. What exactly is inflation?
Simply put, inflation is the rate at which the general price level for goods and services is rising, and subsequently, the purchasing power of your currency is falling. So the same dollar buys you less tomorrow than it does today. Economists measure it using things like the Consumer Price Index, CPI, that tracks a basket of common goods and services, or the GDP deflator.
And what actually causes it? Why do prices start going up across the board?
Well, there are a few main drivers. You've got demand pull inflation, that's basically too much money chasing too few goods. Everyone wants to buy, but supply can't keep up. Then there's cost push inflation. This happens when the costs for producers go up, like raw materials or wages, and they pass those higher costs on to consumers via higher prices.
Like we saw with energy prices recently.
Exactly. That can push costs up for almost everything. Another factor is an increase in the money supply itself. If there's just more money floating around without a corresponding increase in goods, prices tend to rise. And finally, expectations matter. If everyone expects prices to rise, businesses might raise prices preemptively, and workers might demand higher wages, which can, become a self-fulfilling cycle.
Okay, so inflation basically chips away at our savings and makes everything cost more.
That's the main impact, yes. It erodes the value, the real value of your savings if they aren't earning interest at a rate higher than inflation. It pushes up your cost of living. And if your wages don't keep pace, your actual purchasing power, your real income, goes down. And even low inflation adds up. Like 3% a year might not sound like much, but over a decade, that can seriously reduce what your money can buy.
Which really highlights why just saving isn't always enough. You need to think about investing too.
Precisely. Now, the opposite is deflation, prices going down. It sounds good initially, maybe, but is it always?
Yeah, cheaper stuff sounds great. What's the catch?
Well, while falling prices seem nice for consumers at first glance, a sustained period of deflation can actually be pretty bad for the economy overall. It can be caused by things like supply massively outstripping demand, a big drop in overall spending, a shrinking money supply, or maybe huge technological leaps making things way cheaper to produce.
Okay, so if things are getting cheaper, why is that a problem?
The big worry is that if people expect prices to keep falling, they might delay making purchases. Why buy a new car today if it'll be cheaper next month?
Right. Everyone waits.
And if everyone waits, consumer spending drops. Businesses see falling sales, so they might cut production, cut wages, or lay people off. This can create a nasty downward spiral. Falling demand leads to falling prices, leads to falling incomes, leads to even less demand. It can really stall the economy and even tip it into recession. Plus, deflation makes existing debt harder to pay back in real terms because the value of the money you owe has actually increased relative to prices and potentially your income.
Okay, so inflation, money buys less, prices up, deflation, prices down, but risks economic slowdown and makes debt heavier. Got it. How does this directly tie back to personal saving strategies?
Connecting it back, the impact of inflation on your savings is huge. If your savings account earns, say, 1% interest, but inflation is running at 3%, the real purchasing power of your savings is actually shrinking by 2% each year. This makes it absolutely critical to choose savings and investment strategies that have a realistic chance of outpacing inflation over the long haul. That's how you protect and grow your real wealth.
So, yeah, that basic savings account might actually be losing you money in real terms during inflationary periods.
It very well could be. And regarding deflation, while cheaper prices look tempting, the risks people delaying spending, potential job insecurity often outweigh the benefits. It can really harm businesses and the economy overall.
Makes sense. Okay, let's tackle another term that causes some jitters. Recession. What exactly defines an economic recession?
Generally, a recession is understood as a significant, widespread decline in economic activity that lasts for more than just a few months. You see it reflected across several key indicators. A drop in real GDP, falling real income, rising unemployment, lower industrial production, and declining sales at both wholesale and retail levels.
We often hear that rule of thumb, 2 consecutive quarters of negative real GDP growth. Is that the official definition?
That's a very common benchmark, especially in the US, and a strong indicator. But it's not the only definition, and different countries or organizations might look at a broader set of factors. Sustained weakness in output, a significant jump in unemployment. These are also classic signs. Other warning flags can include things like persistently weak consumer and business spending, rising loan defaults and business failures, falling consumer confidence, a significant stock market downturn, and sometimes an inverted yield curve.
An inverted yield curve.
Yeah.
What's that?
Yeah. That's when interest rates on long-term government bonds actually fall below the rates on short-term bonds. It's historically been a fairly reliable, though not perfect, predictor of upcoming recessions. It suggests investors expect rates to fall in the future, likely due to an economic slowdown.
Interesting. So the economy naturally goes through these cycles: expansion, peak, recession, trough. What usually triggers a recession? What pushes us off the peak?
Recessions can be kicked off by various things. Sometimes it's a sudden negative shock. Think of the oil crises in the 70s or the recent pandemic. The bursting of asset bubbles is another common cause, like the dot-com crash or the 2008 housing crisis, where asset prices got way ahead of their fundamental value and then collapsed. Sometimes an economy just grows too fast, overheats, creates imbalances, and then corrects downwards. And financial factors play a role too, like a sudden credit crunch where it becomes much harder for businesses and consumers to borrow money.
And the effects of a recession can be pretty tough on individuals, can't they?
Yeah. Oh, absolutely. Recessions typically mean higher unemployment, which is obviously devastating for those who lose their jobs. Companies usually perform worse, profits fall, and the stock market often takes a hit as confidence drops. Borrowing can also become more difficult or expensive as lenders get more cautious. And if a recession is particularly deep and long-lasting, we might call it an economic depression, which signifies a much more severe downturn.
So paying attention to these recession indicators could help us maybe brace ourselves a bit in our personal finances.
Definitely. Connecting this back to you, understanding these signs helps you anticipate potential risks to your job or your investments. If you see signs the economy might be slowing down, it could prompt you to take proactive steps, like maybe boosting your emergency savings. Having that buffer is crucial if your income takes a hit.
Yeah, maybe holding off on big non-essential purchases for a bit too.
Exactly. Maybe reassessing your budget, becoming a bit more conservative with spending.
And governments and central banks usually step in during recessions, right? They try to soften the blow.
Yes, absolutely. How the government uses fiscal policy, its spending and tax tools, and how the central bank uses monetary policy managing interest rates and the money supply can really influence how bad a recession gets and how quickly we recover. Their actions impact borrowing costs, job availability, things that directly affect your wallet. So being aware of potential policy responses helps you understand the bigger picture. Money Vision IQ podcast.
All right, solid foundations. Now let's get into decoding the economy using some of those big macroeconomic indicators, starting with Giant. Gross domestic product, or GDP, what is it exactly?
GDP, gross domestic product, is basically the broadest measure of a country's economic output. It represents the total monetary value of all the finished goods and services produced within a country's borders over a specific time period, usually a quarter or a year. Think of it as the total size of the economic pie.
How do they actually calculate such a huge number? Seems complicated.
There are three main ways which should theoretically give the same result. There's the production approach, summing up the value added at each stage of making things. There's the income approach, adding up all the income earned, like wages, profits, rent, interest. And then the most commonly cited one is the expenditure approach. This adds up total spending. GDP equals consumption, C, by households, plus investment, I, by businesses, plus government spending, G, plus net exports, NX, which is exports minus imports, C plus I plus G plus NX.
Okay, C plus I plus G plus NX. And we hear about nominal versus real GDP. What's the difference and why does it matter?
Crucial distinction. Nominal GDP measures output using current prices. So if prices go up because of inflation, nominal GDP will go up even if we didn't actually produce more stuff. Real GDP adjusts for inflation. It takes out the effect of price changes to give a clearer picture of whether the actual volume of goods and services produced has increased or decreased. So when economists talk about economic growth, they're almost always talking about the growth rate of real GDP. That's the key indicator of health.
Got it. So real GDP tells us if the pie is actually getting bigger, not just if the price tags on the slices went up.
Yeah.
What else does GDP tell us?
Well, it gives that fundamental measure of the size and performance of the economy. Is it growing, shrinking? How fast? If you divide GDP by the population, you get GDP per capita, which is often used as a rough proxy for the average standard of living. Rough because it doesn't tell you about distribution. It's also important to remember what GDP doesn't count. it misses non-market stuff like unpaid housework or volunteer work. It doesn't count intermediate goods, the parts used to make the final product. It ignores sales of used goods and illegal activities.
So it's a powerful number, but not a perfect measure of everything. Who uses this GDP data mainly?
Oh, it's vital for policymakers, governments, central banks. They use it to guide fiscal and monetary policy. Should they cut taxes, raise rates, spend more? Businesses use GDP trends to make decisions about investing, expanding, hiring. And for the public, it gives a general sense of the economic climate we're living in.
And connecting it back to us, how does a growing GDP usually impact our personal finances?
Connecting to personal finance, a growing real GDP generally signals a healthy economy. That usually translates into more job opportunities as businesses expand. When more people are working, there's potential for incomes to rise overall, which is obviously good for individual financial health.
So more jobs, potentially better pay.
Right. People tend to feel more optimistic, maybe spend a bit more freely, businesses invest more, and it can create a positive cycle.
And understanding that real versus nominal distinction is key to knowing if things are truly improving.
Absolutely critical. A rise in nominal GDP might just be inflation masking stagnation. Real GDP growth tells you if the economy's productive capacity is actually expanding. That's what supports sustainable improvements in living standards and genuine increases in what we can afford. You want to see that real growth number moving up? Money Vision IQ podcast.
Okay, next key indicator, the unemployment rate. We hear this one all the time. What does it actually tell us?
The unemployment rate measures the percentage of the labor force that is currently jobless but actively looking for work. The labor force itself includes everyone who is either employed or unemployed and actively seeking a job.
How do they figure out who counts as actively looking? How's it calculated?
In the U.S., it's mainly done through a big monthly survey, the Current Population Survey, CPS. To be counted as unemployed, you have to meet 3 criteria. You don't have a job currently, you are available to take a job, and you have actively looked for work sometime in the past 4 weeks. People who aren't working and aren't looking like full-time students, retirees, people staying home to care for family, they're considered not in the labor force, so they aren't included in the rate calculation.
So it's specifically measuring people who want a job and are trying to find one but can't. Why is this rate such a big deal for gauging economic health?
It's a really important barometer. A low unemployment rate usually signals a strong economy where jobs are plentiful. Businesses are hiring, people are working. A high rate, conversely, usually points to economic distress. Jobs are scarce, people are struggling to find work. Economists also break unemployment down into different types, Frictional is temporary, between jobs. Cyclical rises and falls with the business cycle. Structural is a mismatch between skills and available jobs. Institutional relates to things like minimum wage laws.
And that main number we hear, the headline rate, doesn't tell the whole story, does it? I've heard there are other measures.
That's right. The official rate, technically called U3, is the most common one reported, but the Bureau of Labor Statistics actually calculates several measures, from U1 to U6. These broader measures, especially U6, give a fuller picture of labor underutilization. They include people unemployed for a long time, those who've given up looking discouraged workers, and people working part-time because they can't find full-time work.
So the U6 rate includes the underemployed and discouraged workers. That seems important.
It gives a much wider lens because high unemployment, however you measure it, obviously hurts the economy, less production, less spending, and it has a huge personal toll on individuals and families, loss of income, stress, uncertainty.
So connecting it back, how does a low unemployment rate generally impact our personal finances? Sounds positive.
Generally, yes, low unemployment is good news for personal finances. It usually means greater job security. If you have a job, you're less likely to lose it. And in a tight labor market where employers are competing for workers, it can lead to better wage growth, more jobs, potentially higher pay that directly improves financial well-being.
But we should probably look beyond that headline U3 number for a real sense of job security.
If we connect this to your personal finance, definitely. While a low U3 rate is good, it might mask underlying issues if lots of people are stuck in part-time jobs when they want full-time, or if many have just given up looking. Looking at broader measures like U6 gives you a more nuanced understanding of income security in the economy. Are there truly enough good full-time jobs available? That perspective is really useful when assessing your own situation. Money Vision IQ podcast.
Okay, let's talk interest rates. We hear about them constantly. Mortgages, credit cards, savings accounts. What exactly are they and why are they so impactful?
Fundamentally, an interest rate is the cost of borrowing money, Or, looking at the other side, it's the compensation you get for lending or saving your money. It's basically the price of money over time.
And there seem to be different kinds: nominal, real, effective. Can you break those down?
Sure. The nominal rate is the one you usually see advertise the sticker price, basically. The real interest rate is arguably more important because it accounts for inflation. You calculate it by subtracting the inflation rate from the nominal rate. It tells you the true change in your purchasing power. The effective rate, often shown as APR, annual percentage rate, for loans, or APY, annual percentage yield, for savings, gives you the total cost or return over a year, factoring in compounding and any fees. APY is usually higher than the simple rate because it includes the effect of earning interest on your interest.
Right. Compounding, that's where the real growth can happen over time, especially with savings.
Exactly. Simple interest is just calculated on the initial amount. Compound interest is calculated on the principal plus any interest already earned. It makes a huge difference for long-term investments.
So what makes these rates go up or down? What are the key drivers?
Several big factors. The overall health of the economy plays a huge role. How willing people are to save versus spend matters. Inflation is critical. Lenders demand higher nominal rates to protect themselves against rising prices, eroding the value of the money they get paid back. The riskiness of the borrower is also key. Riskier borrowers pay higher rates. And very importantly, the central bank's monetary policy is a major driver. Their target rates, like the federal funds rate in the U.S., act as a benchmark that influences rates across the economy.
Okay, so they hit us both when we borrow and when we save. Pretty significant.
Hugely significant. Interest rates directly affect the cost of mortgages, car loans, student loans, credit card debt, personal loans. Lower rates mean cheaper borrowing, which can stimulate spending. Higher rates make borrowing more expensive, which can slow things down.
And it's not just debt, right? They affect savings and investments too.
Absolutely. Higher rates generally mean better returns on savings accounts, CDs, bonds, and other fixed income stuff. Lower rates mean less return for savers. There's also that inverse relationship with existing bond prices. When market rates go up, the price of older bonds with lower rates tends to fall. The impact on the stock market is more complex, but rates influence company borrowing costs and the relative attractiveness of stocks versus bonds. And as we said, central banks use rates as their main lever to manage inflation and steer the economy.
So getting a handle on interest rates seems pretty essential for any financial decision.
If we connect this directly to personal finance, interest rates touch almost everything. They determine how affordable debt is and what kind of return you get on your savings. Higher rates help savers but hurt borrowers. Lower rates do the opposite. They also shape the whole investment landscape. Understanding rates is just crucial for making informed choices.
And you emphasized the real interest rate. Why is focusing on that so important?
Because the real rate tells you the true story after inflation. A 3% nominal return on savings might feel okay, but if inflation is 4%, your purchasing power is actually shrinking by 1%. Looking at the real rate helps you understand the actual cost of borrowing and the genuine return on saving, which is vital for long-term planning. A positive nominal rate can easily be a negative real rate. Money Vision IQ podcast.
Let's shift focus to the institutions pulling some of these levers, central banks, like the Federal Reserve here in the U.S. What are their main goals, their primary job?
Central banks like the Fed, the Bank of Canada, the European Central Bank, ECB, are basically vital public institutions tasked with managing a country's monetary policy. Their core objectives usually revolve around a few key things: maintaining price stability, which means keeping inflation low and predictable, promoting maximum sustainable employment, supporting stable long-term economic growth, and ensuring the overall stability of the financial system.
That's a hefty mandate. How do they actually carry out these roles? What do they do?
They have several key functions. They're typically the only entity allowed to issue the national currency. They act as the government's bank and the banker's bank, providing liquidity and payment services. They often serve as the lender of last resort, stepping in to lend to solvent banks facing short-term cash crunches to prevent wider panic. They oversee payment systems, supervise banks to ensure they're sound, and manage the country's foreign currency reserves. But arguably their most critical role, especially for our discussion, is conducting monetary policy, influencing the supply and cost of money and credit to achieve those big economic goals.
And we often hear about central bank independence being important. Why is that considered so crucial?
Independence from short-term political pressures is generally seen as vital for effective and credible monetary policy. It allows the central bank to make decisions based on long-term economic health and objective data, rather than being swayed by, say, upcoming elections or political agendas. This helps build public trust that they're acting in the best interest of the economy's stability.
So even if we don't interact with the Fed directly, their goals and actions really do affect our daily financial lives.
Absolutely. Connecting it back, their goals directly impact you. Price stability. That protects the purchasing power of your wages and savings. Maximum employment. That means a better job market, more opportunities, better income prospects for everyone. Financial stability. That prevents crises that could wipe out savings or disrupt the economy.
And do their actions, or even just what they say they might do, influence our decisions?
Definitely. Central bank actions like changing interest rates have direct effects, but even their communication was called forward guidance, where they signal their future intentions, can significantly shape market expectations. If the Fed hints strongly that rate cuts are coming, markets react, and that might influence your decision about, say, refinancing a mortgage or taking out a loan. Understanding these signals helps you anticipate changes.
Okay, so they have these big goals. How do they actually try to achieve them? What are the main tools in their toolbox?
Central banks have several key policy tools to influence the economy, mostly by adjusting the money supply and interest rates. The most common tool is open market operations. This is where the central bank buys or sells government bonds, usually from or to commercial banks. Buying bonds injects money into the banking system, increasing the money supply and pushing interest rates down. Selling bonds does the opposite. It pulls money out, decreasing supply and pushing rates up.
Yeah, what about those reserve requirements we hear about sometimes?
Right. Reserve requirements dictate the minimum percentage of deposits that banks must hold in reserve, rather than lending out. If the central bank lowers the requirement, banks can lend more, potentially increasing the money supply and lowering rates. Raising it restricts lending and tightens conditions, though this tool isn't adjusted very frequently in most major economies nowadays.
And the discount rate or policy rate, what role does that play?
The discount rate in the U.S., or the policy rate in other countries, is the interest rate at which commercial banks can borrow directly from the central bank itself. Changing this rate signals the central bank's policy stance and influences other market rates. A lower rate encourages banks to borrow and lend more. A higher rate discourages it.
Have they developed any newer tools, especially since the 2008 crisis?
Yes, definitely. Interest on reserves is one the central bank pays interest on the funds commercial banks hold with them. This helps set a floor under short-term market rates. Reverse repurchase agreements, or reverse repos, are another tool to manage short-term liquidity and rates. And then there's quantitative easing, or QE. That's large-scale purchases of assets like long-term bonds to inject liquidity and push down longer-term interest rates, especially when short-term rates are already near zero. And as we mentioned, forward guidance, just communicating future intentions, has become a really important tool as well.
So a fairly diverse toolkit. Do all central banks use these tools in the exact same way?
No, not exactly. The specific tools used and how much emphasis is placed on each can vary quite a bit depending on the country's financial system, its current economic challenges, and the central bank's specific mandate. For instance, some might rely more on reserve requirements than others or use QE more readily. It's tailored to their specific context.
But the end goal is usually similar, managing the cost and availability of money and credit.
If we connect this to your personal finance, yes, that's the core idea. They manage how easy or hard it is to get money and what it costs. Lowering key rates generally means cheaper mortgages, car loans, credit cards for you. Raising rates makes them more expensive. Their actions on the money supply also feed into these rates. So understanding these levers helps you anticipate changes in your own borrowing costs and credit access.
And you mentioned the emphasis can differ, say, between the Fed and the Bank of Canada or the ECB.
Exactly. While they all use similar tools, the specific mix and emphasis can reflect differences in their economies or financial structures. For example, the way the ECB operates across many different member countries presents unique challenges compared to the Fed operating within a single country. The Bank of Canada might have different priorities based on Canada's reliance on commodity prices, so the exact implementation, the way they use the tools, can look different even if the tools themselves are familiar.
So let's drill down. What are the direct, tangible ways these monetary policy choices affect our personal finances day to day?
Okay, so when the central bank uses expansionary policy, think lower rates, maybe QE, increasing the money supply. The goal is to stimulate the economy. For you, this usually means lower borrowing costs. Mortgages get cheaper, car loans get cheaper. It encourages spending and investment. The potential downside, though, is that it can fuel inflation, which eats away at your purchasing power.
Right, and contractionary policy is the opposite, trying to cool things down.
Exactly. That involves raising rates, maybe shrinking the money supply. The aim is to slow down an economy that's overheating and curb inflation. This results in higher borrowing costs for you. Mortgages, loans, credit cards all get more expensive. But the upside is it can help stabilize prices.
How do these policies impact our savings and investments specifically?
Lower rates generally mean lower returns on savings accounts, CDs, and bonds. Savers earn less. Higher rates, conversely, mean better returns for savers holding cash or fixed income investments. For the stock market, it's more complex. Lower rates can sometimes boost stocks because borrowing is cheaper for companies, potentially increasing profits. Higher rates can dampen stock prices and make safer bonds look relatively more attractive.
And does how much we understand about this stuff actually affect how we react?
Research suggests it does. People with higher financial literacy tend to understand these policy shifts better and are more likely to adjust their own borrowing, saving, or investing behavior accordingly.
So staying informed about central bank actions is pretty important for managing our own money.
If we connect this to personal finance, absolutely. Central bank rate decisions directly hit your wallet through loan costs and savings returns. Lower rates aim to make borrowing cheaper, boost spending, but risk inflation. Higher rates make borrowing costlier, aim to control inflation, and might boost savings returns. Staying aware helps you navigate.
And it seems like policy isn't always perfectly effective. Just lowering rates might not work if people are too scared to borrow.
That's a crucial point. The effectiveness also depends heavily on individual confidence and financial literacy. If consumers are worried about their jobs or the future, even rock-bottom interest rates might not encourage them to take on more debt or spend more. So it's an interplay between policy and psychology. Money Vision IQ podcast.
Okay, let's switch gears from central banks to the government itself and talk about fiscal policy. What are the basics here?
Fiscal policy is essentially how the government uses its budget, specifically its spending levels and taxation policies, to influence the economy. They use these tools to try and manage things like overall demand, employment, inflation, and economic growth. The two main levers are government spending and taxation.
So if the economy is sluggish and the government wants to boost it, what kind of fiscal actions might they take?
That's called expansionary fiscal policy. They could increase government spending, maybe on infrastructure projects, defense, education, social programs, puts more money into the economy directly. Or they could cut taxes, income taxes, corporate taxes. This leaves more money in the pockets of individuals and businesses, hoping they'll spend or invest it.
And the opposite, if the economy is running too hot and inflation is a problem.
Then they'd likely use contractionary fiscal policy. This could mean decreasing government spending or increasing taxes, or maybe a combination of both. The goal is to reduce overall demand and cool down the economy.
What are the big picture goals governments usually have in mind when using fiscal policy?
Generally, they aim for sustainable economic growth, achieving full or near full employment, keeping prices stable, maybe achieving a fairer distribution of income, and trying to smooth out the big ups and downs of the business cycle.
You mentioned automatic stabilizers earlier. Can you remind us what those are?
Right. Automatic stabilizers are features built into the tax and spending system that automatically work against the economic cycle without needing new legislation. Think of unemployment benefits. When a recession hits and people lose jobs, spending on unemployment benefits automatically goes up, providing income support. Similarly, progressive income tax systems mean that when incomes fall during a recession, people automatically pay less in taxes. These things help cushion the blow during downturns and restrain things during booms.
And is there a sort of ripple effect, a multiplier, when the government changes spending or taxes?
Yes, the fiscal multiplier effect. The idea is that an initial change in government spending or taxes can lead to a larger overall change in economic output. If the government spends $1 billion on roads, that money goes to workers and companies who then spend some of it, which becomes income for others, and so on. The size of the multiplier depends on how much people tend to spend out of any extra income they receive.
So these government budget decisions have a pretty wide impact on the whole economy.
If we connect this to your personal finance, absolutely. Government spending and taxing decisions profoundly shape the overall economic environment, affecting job availability, income levels, price stability, all of which directly impact your financial well-being.
And the specific taxes used or where the money is spent matters too, right? It's not all the same.
Definitely not. An income tax cut affects people differently than a sales tax cut. Spending on infrastructure creates different jobs and economic effects than spending on healthcare or education. These choices influence your take-home pay, the prices you pay, and the public services available to you. Money Vision IQ podcast.
Okay, let's get more specific. How do these policy choices hit our individual finances directly?
Well, changes in income tax rates are probably the most direct hit. Lower rates mean more disposable income in your paycheck. Higher rates mean less. Simple as that, usually.
And government spending. How does that translate to my wallet?
Government spending can create jobs directly if they build a bridge, they hire construction workers. It can also stimulate demand indirectly. More spending means businesses might need to hire more people to meet that demand, so it affects job creation and income levels in certain sectors and the wider economy.
We touched on this briefly, but government borrowing to fund spending that can potentially nudge interest rates.
It can. If the government runs large deficits and borrows heavily by selling lots of bonds, it increases the demand for borrowed funds in the market. This could lead to higher interest rates overall, potentially making borrowing more expensive for everyone, including individuals and businesses. It's often debated how strong this effect is, but it's a potential consequence.
And governments use taxes to encourage certain things too, don't they? Like saving for retirement.
Exactly. Tax policies are often designed to incentivize behavior. Tax deductions for retirement contributions encourage saving. Tax credits for buying electric cars or installing solar panels encourage those specific choices. These can make certain financial decisions more attractive for you.
What about direct payments like unemployment or Social Security?
Those have a very direct impact. They provide crucial income support for people who are unemployed, retired, or have disabilities. They're a vital part of the social safety net and directly boost the recipient's personal finances.
And we should probably keep an eye on government debt levels too, if they borrow too much.
That's an important long-term consideration. Persistent government deficits lead to growing national debt. While borrowing can fund useful things now, large debts need to be serviced, paid interest on, which can mean higher taxes in the future or less money available for other government spending. It's a trade-off.
So, wrapping up fiscal policy's impact on us.
If we connect this back, government taxing and spending directly affect the money you have available. Tax changes alter your paycheck and what you owe. Government spending influences jobs and income levels.
And those safety net programs are really key for stability, especially in tough times.
Absolutely. Fiscal policies that address inequality and provide safety nets like unemployment insurance and Social Security are crucial for individual financial stability, particularly during economic downturns. Understanding these provides important context for your own financial planning. Money Vision IQ Podcast.
Let's zoom out now and look at the different ways economies are organized around the world. We hear about market economies, command economies, mixed economies. What are the key differences?
Right. A market economy is basically one where most economic decisions what gets produced, how it's distributed, what things cost, are driven primarily by supply and demand interacting in markets. It's decentralized.
What are the core features or principles of a market system?
Key characteristics usually include strong private property rights, people and firms can own things, freedom of enterprise and choice. You can start a business, choose a job, buy what you want. The profit motive or self-interest driving activity, lots of competition between businesses, and prices acting as the main signals coordinating everything. The government's role, in theory, is limited, enforcing contracts, protecting property, maybe ensuring competition.
So prices are the key messengers in a market economy.
Absolutely vital. Prices signal scarcity, they signal demand, they guide producers on what to make and consumers on what to buy. For consumers, the big advantage is usually a wide variety of goods and services, and competition often pushes companies to be efficient and innovative.
But market economies aren't perfect, are they? What are the potential downsides?
No system is perfect. Pure market economies can lead to significant income inequality. They can suffer from market failure situations where markets don't allocate resources efficiently, like with pollution, externalities. You can get monopolies or powerful firms that reduce competition. And sometimes social or environmental concerns might be ignored if they don't align with profit motives.
How does living in a market economy shape our personal financial choices and opportunities?
If we connect this to personal finance, it gives you a lot of autonomy. You have freedom in choosing your career, which heavily influences your income potential. You decide how to spend your money on your needs and wants. And you have opportunities to save and invest to build wealth through various market mechanisms.
So lots of freedom, but we need to pay attention to those price signals the market sends us.
Exactly. Those prices are crucial information for your budgeting, your purchasing decisions. They reflect supply and demand and help you make informed choices about how to allocate your own scarce resources, your money.
Now contrast that with a command economy. How does that work?
A command economy is pretty much the opposite. The government makes most of the key economic decisions. Central planners decide what gets produced, how resources are allocated, and often set the prices. You typically see public ownership of major industries, limited consumer choice because production is planned centrally, and very little competition.
Are there any perceived advantages? And what are the typical drawbacks?
Well, proponents might argue it can lead to greater social equality, stability, and can mobilize resources quickly for big national goals. But the disadvantages are usually significant. They tend to be inefficient because they lack market signals and competition. There are fewer incentives for innovation, and economic freedom and consumer choice are heavily restricted. Central planning often leads to shortages of things people want and surpluses of things they don't.
And then there's the middle ground, mixed economies, which seem most common.
That's right. Most countries today are mixed economies. They combine elements of market systems with elements of government intervention. So prices still play a big role, but the government also intervenes through regulations like environmental or labor laws, subsidies, providing public goods like roads or schools, and running social welfare programs. There's usually a mix of private and public enterprise.
What are the pros and cons of that mixed approach?
Potential advantages include getting the efficiency benefits of markets while having government step in to provide safety nets, correct market failures, and pursue national priorities. Challenges can include government intervention distorting markets sometimes, the risk of regulations being influenced by special interests, regulatory capture, and potentially higher taxes needed to fund the government's role. We should also briefly mention traditional economies, often in rural areas where customs and traditions dictate economic life.
So understanding these systems gives us a better global perspective, relevant even for our own finances.
If we connect this to personal finance, it provides crucial context. It's definitely relevant if you're thinking about international investing. You need to understand how different markets operate. And it helps you understand how global events happening in countries with different systems might ripple back and affect your finances through trade or investment flows. Money Vision IQ podcast.
Let's talk about economic growth now. We generally assume growth is good, but how exactly does it help our personal financial health?
Economic growth, meaning an increase in the total value of goods and services produced, usually measured by real GDP growth, can definitely boost your personal financial well-being in several ways. One of the biggest positives is usually more job opportunities. As the economy expands, businesses tend to hire more people, pushing unemployment down.
And more jobs often means better pay, right? As companies compete for workers.
Exactly. In a growing economy with a tightening labor market, there's often upward pressure on wages and salaries. This means higher potential income for individuals, leading to improved living standards and greater purchasing power. Generally, when the economy is growing, confidence is higher, people spend more, businesses invest more, and this can feed back into more growth. It also tends to be good for investment returns. Stocks often do well, real estate values might rise.
So it can create a kind of positive upward spiral for personal finances.
It can, yes. More jobs lead to higher incomes, which fuels more spending, encouraging more production and investment, leading to more jobs. It's a virtuous cycle when it works well, improving living standards and investment opportunities. And having good financial literacy is key to actually taking advantage of these opportunities when they arise.
But can rapid growth have downsides for us individually? Are there potential negative consequences?
Yes. Rapid or unbalanced growth can have downsides. A common one is inflation. If demand grows too fast and outstrips supply, prices rise, eroding your purchasing power, even if your nominal income is going up. Also, the benefits of growth aren't always shared equally. It can sometimes lead to widening income inequality, where some groups benefit much more than others. There could be negative side effects too, like environmental damage if growth isn't sustainable. And rapid growth can sometimes inflate asset bubbles, stocks, or housing becoming way overvalued, which can burst and cause big losses. An economy growing too fast can overheat and become unsustainable, eventually leading to a recession. And sometimes growth is fueled by too much household debt, creating risks down the line.
So growth is generally good, but it needs to be sustainable and ideally broadly shared.
Precisely. Connecting it back, while growth usually means a better job market and more income, it can also bring inflation that eats away at your money's value, and the benefits might not reach everyone equally.
And we need to be wary of those longer-term risks like bubbles or too much debt that can build up during boom times.
Absolutely. Those long-term vulnerabilities, asset bubbles, excessive debt, can pose real threats to your financial security later on, even if things feel good during the growth phase.
You mentioned education and skills earlier as being important for leveraging growth. Can you expand on that link?
Certainly. Education and skills, what economists call human capital, are fundamental drivers of economic growth itself. A more skilled workforce is more productive, more innovative. For individuals, investing in your education and acquiring skills that are in demand significantly boosts your earning potential and job prospects, especially in a growing economy where employers are looking for talent. Countries that invest heavily in education tend to see faster growth. And crucially, financial literacy is part of this. It helps you understand the opportunities growth presents, manage the risks, and make smart decisions about saving, investing, and managing your money during these periods. Research even links financial literacy to helping people escape poverty.
So investing in ourselves' education skills is even more critical in a growing economy to actually benefit from it.
If we connect this to personal finance, absolutely. Getting skills the market wants is key to better jobs and higher income when the economy is expanding. And financial literacy empowers you to navigate those opportunities and risks effectively, leading to better wealth accumulation and resilience over time. Money Vision IQ podcast.
Okay, let's bring all this down to earth. How can we apply these economic ideas to our daily finances, starting with something basic like budgeting?
Budgeting is essentially personal economics in action. It's about allocating your limited resource, your money, to meet your unlimited, or at least very numerous, needs and wants. That's the core economic problem of scarcity right there.
And every spending choice involves a trade-off, right? That opportunity cost idea.
Exactly. Opportunity cost is fundamental to budgeting. Every dollar you spend on thing A is a dollar you cannot spend on thing B or save or invest. So effective budgeting means consciously considering that opportunity cost. When you think about buying that new gadget, you should also think, what else could I do with this money? Could it go towards my emergency fund, my retirement goal?
So it forces you to be more intentional about where the money goes based on priorities.
Precisely. Prioritizing needs over wants is a key part of it. And then using that opportunity cost lens to evaluate the wants. Is this discretionary purchase worth giving up the next best alternative use of that money? Different methods like zero-based budgeting or the 50-30-20 rule are just frameworks to help you make these allocation decisions systematically.
So budgeting isn't just tracking expenses, it's applying economic scarcity, opportunity cost, to our own money management.
If we connect this to personal finance, that's exactly it. Think beyond the immediate purchase. What's the trade-off? What are you giving up? This naturally leads to more intentional spending and a clearer focus on saving and investing for your future goals.
And by prioritizing essentials and consciously weighing those trade-offs for non-essentials, we make better choices for both today and tomorrow.
Right. It helps ensure your spending aligns with both your immediate needs and your long-term financial security. Money Vision IQ podcast.
Let's talk about saving strategies now. How do those big economic factors like inflation and interest rates affect how we should save?
Saving is crucial, obviously, for building that safety net and reaching goals. But how effective your saving is depends heavily on inflation and interest rates. Inflation, as we know, erodes the purchasing power of your saved money. Interest rates determine the return you earn on it. So the key goal should be to save at a rate or in vehicles that outpaces inflation. If your savings earn less than the inflation rate, you're actually losing real value over time. Your money buys less, even though the number in your account might be going up slightly.
And the interest rates we get on savings accounts or CDs, those are tied to the broader economy.
Yes, directly. The rates banks offer are heavily influenced by overall economic conditions and, importantly, by the central bank's monetary policy decisions. So, when you're choosing where to put your savings, you really need to consider the current interest rate environment and what you expect inflation to be to try and get a positive real return, a return that beats inflation. It might mean looking beyond basic savings accounts to things like high-yield savings accounts or CDs, which might offer better rates, though sometimes with conditions like minimum balances or withdrawal restrictions.
So it's not just how much we save, but where we save it, considering both the interest earned and the bite inflation takes out.
If we connect this to personal finance, exactly. Saving is vital, but inflation is a constant challenge. You need your savings to work hard enough to at least maintain their real value. Aim for a return that beats inflation.
And we need to remember that those savings rates aren't fixed forever. They move with the economy and central bank actions.
Right. Interest rates fluctuate. Understanding that helps you make informed choices about where to park your savings to potentially maximize returns while preserving purchasing power.
Finally, let's touch on investing wisely. How does the economic cycle and all these indicators influence investment decisions?
Investing is generally about seeking long-term growth that can significantly outpace inflation. But investment returns are definitely influenced by the economic cycle, those phases of expansion and contraction, and various economic indicators. Different types of assets tend to perform differently depending on the economic weather. Stocks, for example, often do well during expansions when companies are profitable and growing. Bonds might be seen as safer havens during recessions when people are more risk-averse. Real estate also has its own cycle, often linked to interest rates and economic growth.
So as investors, we should be aware of the economic backdrop when deciding where to put our money.
Absolutely. Watching key economic indicators, GDP growth, unemployment, inflation, interest rates, gives you clues about the economy's current health and potential direction. Understanding whether indicators are leading, coincident, or lagging helps interpret the signals. Are things likely to improve or get worse? This informs strategy. Diversification is also crucial. Spreading investments across different asset classes and sectors helps manage risk, as not everything moves in the same direction at the same time. And adopting a long-term perspective, avoiding panic selling or chasing hot trends, is generally advised.
So it's about understanding how different investments behave in different economic climates and using indicators to get a sense of that climate.
If we connect this to personal finance, yes. The economy's ups and downs directly impact your investments. Knowing how stocks, bonds, real estate typically behave in expansions versus recessions helps you build a suitable portfolio.
And monitoring those indicators helps us adjust our strategy or expectations based on what might be coming.
Exactly. Keeping an eye on economic indicators provides valuable context for your investment decisions, helping you understand the current environment and anticipate potential shifts that could affect your portfolio. Money Vision IQ Podcast.
Let's dig into navigating those economic cycles more effectively. How can we actually identify which stage of the cycle, expansion, peak, recession, trough, we might be in?
Well, recognizing the exact stage in real time can be tricky, but we look for patterns in the data. The expansion phase usually shows sustained GDP growth, falling or low unemployment, and rising confidence. It can last quite a while. The peak is that turning point where growth starts to slow down, maybe inflation picks up. It's often clearer in hindsight. Recession, as we discussed, is typically marked by falling GDP, often 2 quarters, rising unemployment, and declining activity across the board. The trough is the bottom, the lowest point, before recovery and a new expansion begin. Economic indicators are our main guideposts. Consistent, positive, real GDP growth points to expansion. 2 negative quarters signal recession. Things like manufacturing orders, consumer sentiment, leading indicators might hint at turns before they happen. Employment and income, coincident indicators, show the current state. Inflation or unemployment duration, lagging indicators, confirm trends after they've started.
Okay, so we look at a range of indicators. What are the likely impacts on us personally during these different stages, say recession versus expansion?
During a recession, the big risks are job losses or income cuts as businesses struggle. Investment portfolios, especially stocks, often perform poorly due to falling profits and low confidence. On the flip side, interest rates might be cut by the central bank, making borrowing potentially cheaper, although lenders might also tighten standards. During an expansion, you typically see more job opportunities, potentially rising wages as companies compete for workers. Businesses are generally more profitable, which can boost investment returns, especially stocks. However, interest rates might rise during a strong expansion if the central bank tries to prevent overheating and control inflation.
So, different challenges and opportunities depending on the phase. What strategies can help us build resilience regardless of the economic weather?
Building resilience is key. First and foremost, maintain that robust emergency fund aiming for 3 to 6 months of essential living expenses. That's your buffer against income shocks. Second, manage debt carefully. Avoid taking on too much high-interest debt, especially when the economic outlook is uncertain or rates are rising. Maybe prioritize paying down debt during good times. Third, stick to a long-term investment strategy and stay diversified. Don't panic sell during downturns. Diversification helps smooth out the bumps. Fourth, regularly review and adjust your budget. Your income might change, or inflation might impact your expenses differently depending on the cycle. Stay flexible. And finally, stay informed about the economy and don't hesitate to seek professional financial advice, especially during uncertain times.
Excellent advice. Build the buffer, manage debt, invest long-term, stay flexible, and stay informed. That seems like a solid plan for navigating the cycles. Well, we have covered a huge amount today, a real deep dive into these economic principles from your sources, and importantly, connecting them right back to our personal finances. from supply and demand affecting everyday prices to those big forces like inflation and recession, and how central banks and governments try to steer things with their policies. Understanding this stuff really gives us a better lens for managing our money. Money Vision IQ Podcast.
And remembering that economic growth, while usually good, isn't always straightforward. Being financially literate helps you navigate both the opportunities and the potential pitfalls, like inflation or asset bubbles. Applying that economic thinking, scarcity, opportunity cost to your budget, your savings, your investments, and understanding these cycles, it all builds towards greater financial resilience.
We really hope this deep dive has brought some clarity and maybe some actionable ideas for everyone listening. The economy never stands still, so, keep learning, stay curious. Money Vision IQ Podcast encourages you to revisit these ideas as you navigate your own financial journey.
And maybe here's a final thought to ponder. How could getting a deeper understanding of just one specific economic indicator, maybe it's unemployment rate where you live, maybe it's the CPI for the things you buy most often, how could that sharpen your own financial decision-making over the next year?